Good evening on this Wednesday, December 19th. As you can tell, U.S. equity markets sold off sharply after the Federal Reserve raised interest rates by a quarter of a basis point. In addition, the Federal Reserve failed to strike a dovish tone with the markets as they were expecting a dovish tone from the Federal Reserve into 2019. Now, the Federal Reserve did state that they would do only two rate hikes into next year. Equity markets obviously responded negatively to that. The reason why we're seeing sharp sell-off in U.S. equity markets is because basically the Federal Reserve is offloading their $4 trillion balance sheet. Going back several years, at the end of the financial crisis in 2008 into 2014, the Federal Reserve conducted multiple rounds of quantitative easing, basically pumping in trillions of dollars into the financial markets to stabilize the system. They bought mortgage-backed securities and treasury bonds worth $85 billion per month for a good 4 to 5 years. Now the Federal Reserve is basically doing the opposite. They're trying to offload their balance sheet, and the markets are responding negatively. As far as what next year will bring, it looks like it could be a bear market. Obviously, a bear market is when equity prices fall 20% from their all-time highs. What could potentially avert a bear market is if we get a good China trade deal by the end of the year. So we'll see what happens, but if you're in the markets for the long term, continue to stay in the markets for the long term. The worst thing that can happen right now is for you to get out of the markets and jump off. And that's what I have for today.